All right, so today I wanted to do something a little bit different, something that I've never actually talked about, and this is the concept that are the things like CPP, Social Security, are those actually a good thing? Because whenever you talk to the average person about this kind of stuff, they all just assume that it's just a great thing, it's so awesome, and the reality is that it really isn't, and that it's actually kind of a scam. I wouldn't say it's a complete scam, but it certainly is a scam to some degree. And frankly, when you look at these, Social Security, CPP in Canada, they resemble pretty much every aspect of a Ponzi scheme. The only difference is the government just won't allow it to go belly up. They'll print the money, they'll raise taxes, they'll do whatever they have to do for it not to go belly up. But other than that, it resembles all the hallmarks of a Ponzi scheme. And again, what is a Ponzi scheme? A Ponzi scheme is quite simple. You pay out the first investors with the second investors' money, and you pay out the second investors with the third investors' money, and rinse and repeat. And that's exactly what it is. And people think that, CPP, Social Security, that the government is taking the money that you contribute personally, they're investing it for you, and they're giving it to you in retirement. That's not what they're doing. What they're doing is they're taking the money, they're using it to pay out the people that are being paid out right now, because when you look at the boomers, a lot of them did not, they're getting more out of it than they put in. And not to mention too, the other glaring problem with CPP is it's managed absolutely horribly. Like, I think this was a post over the summer, or I seen it. I don't remember exactly when it was, but long story short, CPP was up 1% on the year. And that was at a time when you take like the S&P, for example, was up like 11 or 12%. It was in the low double digits. So this is the other problem, is that it's managed absolutely horribly. And not to mention too, the people that manage it get paid very, very well. I mean, there's several people that make over $1 million that work at, the CPP, and they're grossly underperforming, just blindly buying indexes. Like, that should alarm people. But the other thing that should alarm people is how much money they're actually losing by paying into it. So I wanted to get into that. I'll show the numbers, plain and simple. But first things first, if you get value out of the video, please like and subscribe. Check out the links below as always. So I'm going to go based on my numbers, just because it's easy. And again, I don't make a very insane salary by any means. So it probably is relatable to a lot of people. So first things first, let's just use a compound interest calculator. So I'm contributing roughly $370 a month. Now, again, you also have to keep in mind that they would say, oh, well, half of the contribution is coming from your employer. So again, if you just pulled out a CPP and stopped paying it, who's to say that employer couldn't just give me a pay raise, or, give me a higher bonus or something along those lines, right? So if they're already giving you the money and you withdrew from CPP, they probably would just give it to you in another way, right? So that's an argument that I could see coming up, but that's a stupid argument. So again, $370 a month for 35 years, which again, it's not the exact amount of time that I would have technically, but it's roughly the amount of time. And that's assuming we make 8% a year, which I think you could do 10 or 12. But again, no one knows what's going to happen with the stock market. But I mean, historically, the stock market returns about 8% a year. And keep in mind, if I was doing it myself, I would sell covered calls, which would increase your returns by, 2-3% a year over the long term. But again, I want to keep these numbers conservative, because even when you keep the estimates conservative, you can still show that it's a ripoff. So, and that should really say something. So again, that after 35 years, it'd be roughly $765,000. So let's just get some calculations here on how much money would you have, if you actually invested that money yourself, and then you could actually start taking it out. So $765,000. We're going to assume you could get an 8% return on that per year. So that's $61,200 a year. And then if we divide by 12, that would be $5,100, right? So $5,100 is how much you could get if you were getting an 8% return. Now, let's say you could get a 10%, because I think that's still relatively easy. There's an endless list of covered call ETFs that are getting, 10 to 12 to maybe 15 to 20%. But again, let's keep it conservative. We'll say 10%. And not to mention, too, that a lot of these are still getting positive share price appreciation. So that's not even an issue with most of them. So again, 765 for times 0.1 is 76. So we're going to switch that to divide by 12. So that's $6,375 a month. So again, keep those numbers in your head. $5,100 if you want to be conservative, $6,375 if you want to be slightly more aggressive. I don't think that's overly optimistic. I know there's people that are going to say, "Oh, you can't get 10%." It's like, yeah, you can. Maybe not literally every year, but over the long run, yeah. If you can't take a chunk of money and get a 10%, payout as a form of, dividends or options premium, you're a terrible investor, right? And you don't know what you're talking about, because if there's an endless list of amateurs that can do it and you're a professional and you can't do it, that's pretty embarrassing. So, 63.75, even 5,100 if you want to be conservative. So let's look at CPP, right? CPP. So the max CPP benefit in 2025 is $1,433, right? So that is the max that you can be getting. Now keep in mind, the vast majority of people, I believe it's less than 10% of people are getting the max amount, right? So this is the absolute best case scenario that virtually nobody is getting. If we go back 35 years, it was $574. Now, let's figure out the growth rate. I believe just off the top of my head, that's going to be about 2.5x. 2.49, yeah, almost 2.5. So, and again, let's take that by the current amount to figure out what the estimate will be 35 years from now. Now, again, this is assuming that the amount that it's grown out at the past 35 years is going to be the same as the next 35 years, which, again, it will vary depending on inflation, but for sake of estimating, this is the best way we can do it, right? So it's going to be, let's just round up just to be aggressive. It's $3,600, right? It's $3,600, right? This is roughly how much you'll be getting in CPP or, whatever, 35 years from now, right? Now, again, keep in mind the numbers that I just gave, right? From this number, you could get $5,100 a month if you were to invest that money yourself and get a 8% return. If you could get a 10% return on that money and invest it yourself, you'd be getting $6,375. So again, when I said that I believe that it's a ripoff, well, there's the numbers, right? There's the numbers, black and white. Now, you also have to keep in mind that CPP is taxable, right? So CPP is taxable. So even if you want to make the argument that if you weren't in CPP, that number would be taxable. Well, CPP is taxable too. Right. So there's no difference there. And I know the big argument that people make, which I haven't addressed yet, which I'll address, is the big argument that you always hear is, oh, well, CPP is guaranteed and it's indexed to inflation. There's two caveats to that. Number one, anyone that actually understands inflation knows that the government numbers are BS, right? Anyone that actually understands that, they wildly underestimate it, right? When you look at long-term money supply growth, it's usually in that, 5 to 6% range in the US. In Canada, I think it's actually slightly higher. I think it's around 6 or 7. So actual inflation is actually like double what they're actually telling us it is, maybe even upwards of triple. So when they say, oh, well, it's indexed to inflation, well, yeah, it's indexed to inflation minus 50%. So that argument is retarded. Anyone who's making that they're just lying to you, or they don't understand reality. The other argument that they make, oh, well, it's guaranteed, right? It's guaranteed. Well, again, that argument is also retarded, because if you gave me $1 million and I told you that I will give you a guaranteed $20 a month off that $1 million, nobody's going to make that investment. But it's guaranteed, right? It's guaranteed. Why wouldn't you do it? So whether or not it's guaranteed is totally irrelevant. What's relevant is, what could you be getting? What are comparable options? right? What are comparable options? Now, again, I'm not going to say that the estimate that I made are a guarantee, right? It's not necessarily a guarantee. But what I am saying is that, let's say you take HDIV in Canada is probably the best example I can think of. Now, again, this is an ETF that is currently paying a little over 10%. And I mean, it's been around for over 4 years. And I mean, the share price alone is up about 24%. So you've gotten 5% a year just on the share price, and you're getting 10%. Like, who in the right mind would take CPP over something like this? Now, again, you've had periods where the number has dropped, but when you look at the historical yield on cost for this ETF, right, the historical yield on cost for this ETF, it's actually lower than it's ever been right now. And it's still over 10%. It's lower than it's ever been right now, and it's still over 10%. Right? So, and again, I could give an endless list of examples like this. Like, who in the right mind would put money in CPP when there's alternatives like this that are going to give you, CPP was $3,600 roughly, and you could be getting about $6,500 a month just based on my example in something like this. So again, that's almost double, right? And again, when I say that it's a ripoff, this is exactly what I mean. And again, this is being relatively conservative, right? This is being relatively conservative. Like, I think that if you were doing it yourself, you could get like 10 to 15%. And that would be like borderline triple. So that's the big thing, right? That's the big thing. And again, just to summarize it, the big comeback you're always going to get from these people is the people that are defending it is the whole, it's indexed to inflation and it's a guaranteed payout. And what they like to do is they like to hide behind, credentialism and stuff like that. And they'll say, like, I got an economics degree. I'm a financial advisor. I know what I'm talking about. And you don't. You're just a Joe on the internet. And it's like, you're not addressing my arguments. Right? When people say that, you're not addressing the arguments. And you make yourself look stupid. Because, again, we've already established, and everybody would agree, like anyone that understands finance to the slightest degree would agree that whether or not a payout is guaranteed is totally irrelevant. Like, you can get a guaranteed, like, whatever, 2.5%, 3% buying GICs. You can get a little more buying CDs in the US. You could buy T-bills. You can get 3-4% right now. But there isn't a financial advisor on the planet that would recommend putting all your money in GICs or CDs or T-bills unless you were like very close to retirement, if not in retirement. And even then, I would still argue that's terrible financial advice, which is a story for a different day. I think you can probably understand what I'm getting at regardless. But my point here is that, again, they're going to argue that, it's a guaranteed payout. But what we just established, and like I said, every single financial advisor, if you came to them and said, hey, I just inherited, doesn't matter the amount of money, $10,000, $100,000, and said, hey, I want to put this money towards my retirement down the road. How do you recommend that I invest it? Every single financial advisor on the planet would recommend to have the majority, if not the vast majority of that in stocks. Right? But again, if this whole, it's a guaranteed payout is such a good is such a good defense, well, you wouldn't say that. You would say, you should have the majority of that, or if not all of it, in bonds. Right? And this is the other problem too. Like, this is the other problem. If the average, like 30, 40, 50 years from now, the average life expectancy probably will be, 5 to 10 years longer than it is right now. Again, obviously, for all we know, everybody gets diabetes or something and that changes, but, or some cancer or some disease comes along that starts knocking people out earlier. But if, let's just say the average life expectancy is 85, right? The average life expectancy is 85, and you start taking out at 65, that's 20 years, right? That's 20 years. If you go throughout history, there's only, like, go back 200 years. You could almost certainly, I don't know the numbers off the top of my head, But I would venture to guess that you could count on one hand the amount of times where the stock market underperformed bonds over a decade plus period. I do know the longest period that it ever was, I believe, was 15 or 16 years, going back 200 years, right? So what is my whole point there? My whole point is I think the other important thing here is I think bonds are a terrible investment right now, like terrible. Number one, because when you look at what is the underlying, right? Well, what is the underlying? The underlying is the government and the government's ability to pay off the debt. And when you look at that, governments are constantly taking on more and more and more debt. And not to mention too, when you look at least Canada as a prime example of this, right? Our productivity is going down. It's not like our productivity is going up. Our productivity is going down, at least compared to, going back 10 or 20 years. So what is the problem with that? The problem with that is that we're going to have less people paying into the system and more people taking out, which means governments are going to have to take on more debt to pay off the debt, which it's just going to be a vicious cycle. And my point there is people are going to become less and less willing to loan the government money in the future. Right? People are going to become less and less willing to loan the government money in the future. I mean, look at what's happening with the US, right? This is one of the big things that, China and a lot of these countries are doing. They're buying less and less US government debt, which is going to create a big problem. It already is creating a problem, but it's going to create an even bigger problem. And again, when they say that, the benefits, they're guaranteed, right? They're only guaranteed insofar as the government can increase taxes or just print the money to pay you out. But what's the problem with that? The problem with that is they're literally robbing Peter to pay Paul. They're taking money from you to pay it right back to you. Now, again, they're not doing that literally, but in a way, that's what they're doing, right? Because if they're having to print the money to do it, well, again, that's just going to contribute to inflation. That's just going to make your life worse off in the future to make your life better off now. If anything, it's a net loss. At best, it's net neutral. And this is the problem, is that if people were simply able to do this themselves, or the government actually just did a good job for once, which again, I don't think that's ever going to happen, given it's never happened. I don't see why people would expect that. If people were able to do this themselves, they would be way better off, right? They'd be way better off. Like, you could probably retire 5 to 10 years earlier and have a comparable, if not more money, right? Like, let's just going based off my calculations here. Let's take that same 8%. Let's say you do it over 30 years. I'm just trying to figure out what it would take to get that 3,600 number. Just out of curiosity for how much sooner you could retire, right? So if we take 503,000, which is the number you would have after 30 years. And keep in mind, they're also gonna try and play the whole sequence of returns argument that could throw you off and all that kind of stuff. But again, the point here is still proven. I don't want to get into that because that's another thing it's just trying to throw people off the scent when they do that. So when you look at that, so again, 503,000, that's 40,200 divided by 12. 33. So again, you could retire about 5 years earlier. You could retire about 5 years earlier and still have the same amount. Like, again, like, how much would people give to have 5 extra years of their life that they don't have to work? Like, just think about how much time that is, right? That is how much time you are losing by having to contribute to this. 5 years of your life that you could be, and not to mention too, those are good years, right? I mean, the earlier you can retire, the more fun you can have, because if you retire at 70, it's a lot different than if you're 55 or if you're 60, right? I mean, a lot of people are still in pretty good shape at 55 or 60, but not a lot of people are in really good shape in their 70s, right? So that's another important caveat, that the earlier you can retire, the more you can enjoy it, because the later you are, the worse health you're going to have probably. So again, I know there's going to be pushback to this. I know this is going to be really controversial to some people, but as someone who, and again, like another important point here is that a lot of, Gen Z people and the younger generations complain about getting ripped off. And this is probably the biggest way that you are getting ripped off. And yet nobody is talking about it, right? So the last thing I'll leave it on here is let's just try and figure out just how much money maybe you are losing by having to do this, right? So let's say you retire at 65, you die at 85. So if we take that 5,100 number, so that's going to be roughly $1,500 a month that you're missing out on, and you times that by how many? By 12. That's going to be for a year, and then we times that by 20, which is the amount of time you'd be retired in years. That's $360,000, right? So by having to pay into CPP, based on these estimates at least, you're missing out on about $360,000. Now, again, I would venture to guess that the majority of people that are retired, like if you pulled 65-year-olds in Canada and you took their net worth in things that aren't pensions or their house, i.e., let's just say you took the average 65-year-old and you figured out what their net worth was in just stocks, bonds, and let's say, second, third properties, I bet you the majority of people that are 65 and older do not have more than $360,000. I have no idea what the number is, but again, a lot of these people have, $1 million houses that are paid off, that they could take a HELOC out and they could do a whole lot of things. But I would venture to guess that the majority of people over 65 do not have this much money. And when you look at like Gen Zers and stuff like this is how much money. Again, I think that this is a conservative estimate, if anything, but this is how much money you're missing out on. So just food for thought. So again, this is about 22 minutes, so I'm going to leave it there. So like I said at the start, if you got value, please like, subscribe, comment, check out those links below, and stay tuned for more.